Hello and welcome to our latest investment update as of July 10th, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer. In today's edition, we're going to talk a little bit about the market and economic update and outlook through July 10th. We're also going to take a closer look at the value opportunities we're seeing in the market today. And then finally, a review of our current outlook, which we previewed last week. So first, the update through July 10th. The U.S. economic recovery depends, as we talked about before, on an effective containment of COVID-19. And that's, the story of the day, looking at new cases, particularly in the U.S., rising above 50,000, even 60,000. A full economic recovery won't happen until that's effectively contained or there's a vaccine, as we talked about before. Until that time, though, the U.S. Treasury is looking to a second round of economic impact payments to households. So we would expect that the U.S. government, Congress, as well as the Federal Reserve, will continue to look for ways of supporting the economy until such time. We've also seen outside of the U.S. Some positive news out of China. So at least the Chinese stock market has started to rally. And the rally is really based on recovery hopes for the global economy. We talked about the manufacturing survey last week, but manufacturing is picking up from where it was in March. And that's a good thing for China. And the market's also going up because of very strong government support in that country. And this is positive for the energy market. So as China picks up, as the global economy picks up, there's going to be an increasing demand for energy. And that will stabilize the oil market, which remains oversupplied. The supply during the first half of the year continued to rise, of course, against a demand that fell off a cliff. So this will take a little bit of time to stabilize, but what we are seeing is some positive trends in that energy sector. One of the things we want to focus on is what that means for some of the opportunities we're seeing in the market, and also some of the things that we're seeing, between economically sensitive sectors and also growth sectors. So again, we've updated the market returns here in the U.S. through July 10th. We've talked a lot about this before, but the S&P 500 has nearly erased all of its losses that has occurred at the beginning of the year. It's down minus 1.4% year to date. The differential, however, between growth stocks, which are up over 15%, and value stocks, which are down over 17%, is now 34% so far this year. And it's really, we've talked a lot about value and growth. And value stocks generally reflect the concern that the pandemic has had on the real economy. And we have talked a lot about value and growth as descriptions of investment styles. And just as a reminder, Wescott portfolios have allocations to both. And we've discussed our position in prior webinars in Apple, Microsoft, Amazon, and Google, because those represent the growth market, and those are the ones doing well today and benefiting from the current environment. But today we want to focus a little bit more on the value side of the portfolio, and in particular, the value opportunities we see. Listed here are some of the largest value stock positions we hold in your portfolio, along with their year-to-date returns and their current price to earnings are multiples, which is a measure of valuation. So just going down the list, Intel, Pfizer, AT&T, Comcast, JP Morgan, Chevron, and Berkshire Hathaway. These are very high quality companies, first and foremost, and they are well diversified across technology, healthcare, communications, financials, and energy. And it's really important to sort of take today's environment and look at where the PE of the overall market is trading, which is 21.7 times. And that's a pretty high number relative to history. And then compare where names like Intel, Pfizer, and AT&T and Comcast are trading, which is well below market averages, which suggests that their future returns are higher than the overall market. And that will be realized ultimately when economic conditions improve and earnings return to more normal levels. One name I would highlight this morning is Pfizer. In today's Wall Street Journal, it was highlighted that Pfizer's in partnership with a German company that's coming up with a potential vaccine for COVID-19, and indicated that they might even have doses available by the end of the year. And that is very good news. And that would be a huge help to bring the global economy back to normal. So with a focus on value, what we wanted to do is take a look at, well, where is value in growth trading today as investment styles? And today, value stocks are trading much cheaper relative to growth stocks. So we talk about forward PEs. This is forward price earnings ratios. This is a very common way of determining what's trading cheap and expensive. And we're really looking at valuation multiples as a multiple of earnings. So value is trading at 18 times earnings, whereas growth is trading at nearly 30 times earnings. And the chart on the right-hand side, which comes from JP Morgan Asset Management's Guide to the Markets, does show the relationship or the difference between the valuation of growth and value really back since 1997. And, we feel and we see in this chart that value and growth tend to move in very long cycles. So from 1999 to 2008, where value was very inexpensive or cheap relative to growth, it became more expensive, if you will, but on a relative basis. What that means when that's going up is that value is outperforming growth. On the way down, since 2009 to present, we've seen growth that was very expensive right after the credit crisis become cheaper over time. Value become cheaper over time. And that has provided a very big tailwind for growth investors. But today, where we are today is looking forward, is that value styles in general, the financials, the energy, the industrials, are trading at a much cheaper price relative to growth stocks. In fact, cheaper than they've been since really early 2000s. And that's an opportunity that we see. We want to maintain our allocation and exposure to the value investment style. And we've talked a little bit about this before too, but value strategies have started to rebound in the second quarter of 2020. This is a very good sign. And the manager that we use in client portfolios that accesses the value investment style in a very systematic way is dimensional fund advisors. And what we're showing here is the dimensional fund advisors strategies in client portfolios that follow a value discipline or a core discipline. So in this chart, we're showing DFA large value versus its benchmark, DFA international value versus its benchmark, DFA small value versus its benchmark, DFA emerging markets core versus its benchmark, and then finally DFA global real estate. So one thing to say is that it was a very strong quarter for value strategies in general. You can tell that by looking at the orange benchmark returns, which are all up dramatically, up in double digits, and strong performing off of a very weak first quarter. What we're also seeing, however, is that DFA's approach to value was rewarded even more than the market was. So in each case, we're showing a DFA value, DFA international value examples here of outperformance. So as the benchmark goes up 14.3, for example, DFA large value is up 16.4. And that's because DFA emphasizes companies that are trading cheaper, tend to be a little bit smaller than the big mega cap companies, and have higher quality balance sheets. And we think that given what we're seeing in the second quarter and what we anticipate to be a potential rebound in the global economy, that DFA is very well positioned to capture that value recovery. And they're doing so at a relatively cheap starting point, which is really critical. So to end, again, a reminder of our third quarter 2020 outlook. We still believe that governments will try to limit the spread of the virus without imposing the same severe restrictions that we saw earlier in the year. As a result, we do expect that the economic recovery will continue to rebound and recover, but it will be uneven, and the uncertainty around that unevenness will continue to drive market volatility. As we talked about today, the S&P 500 is trading at a relatively expensive 21 times or nearly 22 times earnings. But we also talked about today in more detail that cyclical sectors, the value side of the market, energy, industrial, financial, these sectors of the market are trading much cheaper than the growth side of the market, which is really driven by technology and consumer staples. So we see that there's great opportunity, and we're actually seeing evidence of that relative performance coming through if we look at the dimensional fund advisors portfolios that we highlighted earlier. And then finally, the upcoming US presidential election will just get louder in terms of the noise around it. It will be another source of uncertainty, and we'd expect that to drive more market volatility. But really what's important in this case is to focus on fundamentals, but and also the value opportunities that we're seeing over the long term. So with that, thank you for joining us. Thank you for your trust. As always, please don't hesitate to reach out to me or your advisor if you have any questions. Thank you.